Hi, my name is Arturo De Jesus. In this session, I'll be walking through stock valuation analysis using Microsoft as my example. I'm applying the driver framework to structure my thinking and explain whether investing 75,000 Microsoft at today's market price of 380 per share makes sense. So I'll start with the driver method. So for the discover. The goal here is to figure out what makes Microsoft valuable. So investors aren't just buying a share price, they're buying a stream of future dividends, and growth potential. In this imaginary world, Microsoft pays um, a $3 annual dividend and it's expected to grow at 4% per year. So with that, we can map out the expected cash flows. So with the $3 dividend today and 4% growth, we'll see dividends rising slowly over time. Since we're using the dividend discount model, the value of the stock equals the present value of all those dividends, assuming they'll grow, continue to grow. So that was represent so for the so implement it. So now we get to apply the Gordon growth model, which is the version of the DDM. So um that means our model suggests Microsoft is worth $52 per share, so far below the current $380 market price. And that is the with the required return of 10%. So that's based on the market's average return and the growth of 4%. So to validate it, we compare. So at $380, the stock seems extremely expensive compared to our intrinsic value of $52. So if I buy $380, my expected return using this growth assumption is about 4.8% annually, which is close to what a treasury bond or even a savings account could earn, but with much higher risk. So with that, E for evolve, um, say dividends grew at 8% instead of 4%, we're looking at 162. So even with much stronger growth, the intrinsic value was still less than half of $380. So this shows how sensitive um valuations are to growth assumptions. So reflecting on all that, the big takeaway is that while Microsoft is a great company, the price you pay matters. So at $380, the return looks too low. To compare a safer alternative like treasure bonds at 4.5%. So for my grandmother's inheritance, I'd recommend not putting the full 75,000 into Microsoft stock. A partial investment might be okay, but um the bonds are safer assets and they would make more sense for conservative income focused portfolio. So in summary, applying the dividend discount model shows Microsoft trading at a premium well above the intrinsic value under reasonable assumptions. This reinforces the valuation is about the relationship between the price and exceptions, not just the quality of the company. So I will share my screen with you. So here we have the full $52 per share. So that is far below the current $380 market price. And then here's all my um, work shown. So you have the growth 4%, the return at 10%, and then evolving to it here, which was 162, which is definitely far less than half the $380. So that is my session 3 video, and I hope you enjoyed it.